A large AI hedge fund lost 67% in July. The stocks it held didn't fall 67%. They fell 20 to 30. The gap between those two numbers is the whole story. The setup was simple. It borrowed to about 4 times its own capital and put it into one basket: AI, semiconductors, and memory. 4 times leverage, one concentrated theme. The trigger came mid-July with TSMC's earnings. Doubt about AI spending spread and semis rolled over. Micron fell more than 20%. SK Hynix more than 32%. A correction, not a collapse. Here's the part worth keeping. At 4 times leverage, a 17% drop in the book is a 67% drop in your money. So don't think of leverage as multiplying returns. It divides how far price can fall before you're gone. At 4 times, that distance is 25%. And from there, you stop deciding. Prices fall, collateral shrinks, the lender asks for more. Can't post it, you get sold out. And that selling pushes prices down again. That's the loop. The real cost of leverage is that you don't choose when to sell. Here's how it ended. The fund handed its equity book to Citadel in a block trade and used it to clear the bank debt. That's why there was no cascade in the tape. One buyer absorbed it at once. Citadel called July a reset, not the end of the bull market. The Bank of England has been warning about exactly this. Hedge fund leverage drains market liquidity precisely when it's needed most. This is that warning as a case study. The manager says no more bank leverage, pure equity from here. That removes forced selling. It also shrinks the upside. You don't get one without the other. One rule to keep. The inverse of your leverage is how far price can fall before you're finished. 2 times, 50%, 4 times, 25, 10 times 10. You can be right on direction and still be wrong on order. Not financial advice. What's your survivable drawdown? Comment and follow.